Hey everyone, welcome to this whiteboard-style explainer on double entry system fundamentals. We are diving straight into the core material you need to absolutely smash that A-star on the IGCSE Accounting 0452 exam. So, grab your notebooks and let's build a rock-solid foundation together.
You know, double entry isn't just some boring record-keeping exercise. It is literally the fundamental bridge between basic data entry and the high-level financial intelligence examiners are desperately looking for. Honestly, mastering this architecture, it's your golden ticket to top marks. Here is our game plan for today. 1. Fundamental concepts. 2. Technical execution. 3. Interpretation and evaluation. And 4. Examiner insights. Let's get into it. Starting right off with Section 1, Fundamental Concepts, and specifically the 2026 terminology shift. Okay, listen up, because there is a massive shift happening right now. For the 2026 syllabus, Cambridge is transitioning to modern international terminology, and it's absolutely crucial that we permanently update our vocabulary. Terms like irrecoverable debts and owner's equity are exactly what they expect to see now. Using the old vocabulary, that's kind of going to cost you unnecessary marks, so we really need to lock these new terms in. Now, right here is the foundation of literally everything we do, the accounting equation. Assets equal liabilities plus equity. This is the unbreakable rule. It has to be maintained throughout the entire fiscal period. Basically, every single transaction has a dual effect. So if an asset goes up, well, another asset just has to go down, or a liability or equity must rise to keep everything perfectly balanced. A really common trap students fall into here is overstating profits by just ignoring potential losses. And that directly violates the prudence concept. The big takeaway for you is this. We always anticipate potential losses, but we never anticipate profits before they're actually realized. Make sense? Moving on to Section 2, Technical Execution. This is our step-by-step flow. So, understanding this procedural flow is super crucial. It all starts with Step 1, the business document. We're talking about your invoice, credit note, or bank statement. That source document feeds directly into Step 2, the books of prime entry. Then from there, we post to Step 3, the ledgers, specifically using our T accounts. And finally, all of those balances are extracted to create Step 4, the trial balance. Now, if we zoom in on the T accounts for a second, mastering this structure really is the gold standard of double entry. The absolutely critical detail here is distinguishing between balance CD, which means carried down at the end of the period, and balance BD, brought down at the start of the new one. Mixing these two up, or just forgetting to bring the balance down altogether, is a super common place to lose easy points. Oh, and there's a fascinating mathematical pitfall here when it comes to discounts. You see, trade discounts happen at the point of sale, and they actually don't appear in the double entry at all. But cash discounts, those happen at the point of payment, and absolutely must be recorded. It is so crucial to calculate these percentages based on the exact discount type. Or guess what? Your entire ledger gets completely thrown off. All right, let's hit Section 3, Interpretation and Evaluation, focusing on Assessment Objective 3. Let's try a worked example using a very common IGCSE command word, state. So, if a business's current ratio dramatically falls from 2.5 to 1 all the way down to 1.1 to 1, state 3 underlying causes. I want you to go ahead and pause this explainer right now. Let's engage that critical thinking. Jot down your answers before we check the solution together. All right, let's see what you came up with. To secure those really high-level marks, we need to carefully analyze the why. The causes could be over-purchased inventory, tying up your funds, maybe a slow settlement of trade payables leading to a cash crunch, or even depleted cash reserves because of a massive capital expenditure. If you spotted those, great job. It means you're thinking exactly like an examiner. Things definitely get tricky when we're asked to evaluate two different businesses. Let's say one uses the straight-line method of depreciation, while their competitor uses the reducing balance method. Because of these differing policies, making a direct apples-to-apples comparison is really difficult. We have to look way beyond the surface numbers and truly evaluate the underlying quality of that reported profit. And speaking of looking beyond surface numbers, we also need to analyze non-financial factors. Things like staff morale, a prime location, or a stellar market reputation. None of these are captured on your T accounts, but they are absolutely vital for evaluating a business's long-term sustainability and its return on capital employed, or ROCE. Finally, we are at Section 4, Examiner Insights, the crucial do's and don'ts. Let's run through a rapid-fire exam checklist straight from recent principal examiner reports. First step, show all your workings. This is huge. Method marks are awarded even if your final calculation is off, as long as your logical flow is visible. Second, maintain clear handwriting in your ledgers. If that B/D isn't readable, the point just isn't awarded. And third, strictly distinguish revenue expenditure from capital expenditure so the income statement isn't distorted. 100%. That is the exact level of accuracy we are striving for in the trial balance phase and in our use of the new 2026 terminology. Achieving that perfect balance allows for a totally seamless transition into drafting those final financial statements. So, I want you to think beyond the exam hall for a second. How does the integrity of your specific accounting records ultimately dictate the annual decisions of major banks, business owners, and tax authorities? The exactness you're practicing right now for this exam, it directly mirrors the real-world transparency required by global financial stakeholders. Keep that big picture in mind as you study. Thank you so much for joining me on this explainer. Keep up the fantastic work, and I will see you next time.